Hi everyone, we will be reviewing P145A on page 43 of your book, which really encompasses all the major objectives of this chapter and introducing you to how modern accounting is completed. This chapter focuses on you starting to analyze a piece of financial data or a transaction. We use a spreadsheet to begin this process because everything is in front of you related to the financial data for that company. For instance, this is Alan Shotton. He recently opened his own accounting firm on April 1st, which he operates as a sole proprietorship. The name of the new entity is Alan Shotton CPA. He experienced the following events during the organizing phase of the new business and its first month of operation. So before we start looking at the transactions, some things I want to bring to your attention. They talked about the different types of entities, business entities in your chapter. In our discussions in Accounting 1, we only use a sole proprietorship or one owner. So this will only be Alan Shotton as the owner. The other thing to be aware of is that during the first 4 chapters, we will only be working with companies that provide a service. They do not sell products. Okay? So with that out of the way, let's start looking at how we analyze. First of all, we always remember our accounting equation. Assets equal liabilities plus equity. And we always have to keep in mind that this equation must always be true. We are not doing algebra in here. So the rules of algebra do not apply. It's just balancing. Everything on one side has to equal everything on the other side. Next, making sure we understand what an asset is. Remembering that an asset is something the company owns. They purchased it. They own it. They have title to it. Or is owed to the company. So Alan Shotton's assets, which you'll always be given, you'll always know the assets, liabilities, and equity of a company, are cash, accounts receivable, office supplies, and furniture. Now, all of those I think we could pretty much understand what they are, but just so you understand, accounts receivable is where we keep track of the amount of money customers owe the company. Then we go on to liabilities. On liabilities are amounts the company owes. Amounts the company owes to creditors. There are 2 typical liabilities that are introduced in the very beginning of your accounting education, and the first is accounts payable. And that is where we keep track of the amount the company owes suppliers. The other liability you may see is called notes payable. And that's where the company keeps track of the amount it owes on loans to the bank. The next major area is equity. We have 4 types of equity. The first is capital. And capital is where we keep track of, for now, how much the owner contributes to the company. So that's the only item you'll see change in that column. Withdrawals, which has a negative effect on the equation, is where we keep track of how much the owner takes out of the business. So they could put money in, they could take money out. It's their business. Service revenue is where we keep track of the amount we charge our customers because we performed a service for them. And that has a positive impact on the equation. Expenses are amounts the company has to pay to conduct their business because they receive services. Okay, so expenses are traditionally services the company receives from operating their business day in and day out. Can't stop a sneeze. Okay, so rent expense is one expense that Alan Shotton will have, and utilities expense. So these are services he has to pay for to conduct his business day in and day out. Okay, so those are all parts of equity. Remember, if you take your revenues for a period of time and subtract all your expenses for a period of time, If the result is positive, we call that net income, or the real world calls it profit. If it's negative, it's a net loss. Everybody calls that a net loss. All right, so just a quick review of those items. So let's go into how we analyze and record these transactions. April 5th, Shonton deposited $75,000 in a new business bank account titled Allen Shonton CPA. The business gave capital to Shonton. I'm sorry I don't have this set up as a fancy PowerPoint where things slide in as we are going over them. We're going to start with our very top line. And it says April 5th, so you want to put your date. Then we ask ourselves, what was affected in this transaction? That is your process of analyzing. You start with, what happened here? Well, the company received cash. Okay, so the cash in the company increased $75,000, so we want to record that in the cash column. Well, why did the company get cash? The owner gave money. Oh, where do we keep track of the amounts of money the owner gives to the company? In the capital. So we'll show that in the capital. Notice assets increased, and on the other side of the equation, the equity area increased by the same amount. It balances. We've just recorded our first transaction for Allen Shonton CPA's business. On April 6th, and it always usually starts with a verb, most of these transactions. So if you want to look at it this way, you could say the company paid $300 cash for letterhead stationery for the new office. So what happened here? Well, the company paid cash, so cash decreased $300. So in the cash column, you want to show a negative $300. I apologize for that. If you heard me yelling, I'm recording in the morning in my home and I heard someone yelling. So if you heard me yelling, sorry about that, but I'm coming forward because I don't want to have to restart my recording. So I apologize for that, and let's continue. Okay, so getting back to transaction B, we're going to decrease the asset cash because we paid cash, and then we're going to increase the office supply, the asset office supply, because that's what was purchased. We increase the amount of office supplies we own. So when we do that, everything occurs on one side of the equation, but that's okay. Negative 300, positive 300, assets equal 0, liabilities and equity equal 0. Now we begin to keep track of a balance, because the first transaction, that was the balance. But now that we're adding more, we want to keep balances of each column as we proceed. So now the cash amount is at $74,700. It decreased. Office supplies are at $300, and Shonton capital's at $75,000. Asset side, $75,000 equals liability and equity side, $75,000. Let's go to the 7th. The company purchased office furniture for the office on account, $9,500. So they purchased, we ask ourselves, what happened? Well, they bought more office furniture. Okay, let's increase the asset column, office furniture, by $9,500. It doesn't say they paid for it. They purchased it on account. When they purchase on account, that means they owe the money. So now they're going to increase the liability column, accounts payable, to show they owe that money. As a liability increases, or we owe more, we increase that column. As we pay liabilities off, we decrease them. Now we'll update our balances. Cash hasn't changed, so it's the same amount. Office supplies hasn't changed. But now furniture is at $9,500. On the other side, accounts payable now has a balance of $9,500, and capital remains the same. So at any point, you could take those balances, add the assets up, and then complete the computation on the other side for the liabilities and equity, and they should equal. The company consulted on the 10th with a tax client and received $4,000 for services rendered. What happened here? The company received cash, So we'll increase the cash column by the dollar amount of $4,000. Why did they get the cash? For services rendered. So we're going to now, this is that they completed a service, Sean completed a service, charged the customer $4,000, so increase service revenue $4,000. And then you update your balances. The 11th, the company paid utilities of $190. So they paid, so that means they paid with cash. Cash decreases $190. Why did they pay cash? What did they pay for? A service, utilities expense. So we're going to put the utilities expense as $190. Now you might see a minus sign there. That minus sign should really be in the little column. Rent and utility expense always has a negative impact on the equation. It doesn't mean you have negative utilities. You can't have negative utilities. If you have utilities, you pay for them. You're keeping track of all the dollar amounts you pay for utilities in that column. So that's like a little error there. So please keep that in mind. But when you're balancing your equation, you always subtract utilities expense and rent expense and withdrawals because they have a negative impact when determining your balancing. On April 12th, the company finished tax hearings on behalf of a client and submitted a bill for accounting services, $20,000. So what happened here? Well, they conducted a service, charged the customer $20,000, but they just sent them a bill. Okay, no cash was received. All right, well, first of all, we definitely have service revenue, so we want to increase that column, service revenue. Since the customer didn't pay, but they owe it, we want to increase the asset accounts receivable because that's where we track how much customers owe us. And then update your balances. On the 18th, the company paid office rent of $750. Okay, so what happened here? The company paid, so that means we got to decrease cash for the amount they paid, $750. What did they pay for? Rent. So again, they have that little minus sign there, but that's just to indicate that rent always has a negative impact on the accounting equation, just like the utility expense. Update your balances. The next, on the 25th, the company received amount due from client that was billed on April 12th. Okay, so how much was billed on April 12th? $20,000. We are keeping track of that in accounts receivable. Well, the company received the cash. So we're going to increase cash, $20,000. Increase the cash, $20,000. Decrease accounts receivable. Because once this customer pays us, they don't owe us anything. So we got to decrease the amount in that column. And then update your balances. Paid the full amount of accounts payable created on April 7th. So remember, we bought the furniture up on April 7th for $9,500, but we didn't pay for it. So we're keeping track of how much we owe in accounts payable. Well, now we're paying it. So we have to decrease cash, $9,500, and decrease accounts payable. Because once we pay this, we don't owe anything. Update your balances. And then the final transaction for this problem is Shonton withdrew cash of $3,500. So the owner took $3,500 out of the business, so we decrease cash and then show that $3,500 in the withdrawals column, knowing that withdrawals always has a negative impact, like expenses, on the accounting equation. And then we come up with the final balance for each column. Now we definitely want to make sure assets equal liabilities plus equity. So we will take the asset amounts of $84,760 plus $300 plus $9,500. And really, I should be doing that. I don't have the total amounts there. Let me grab my calculator. So $84,760 plus $300 plus $9,500. Come on. I'm getting $94,560. Those are the total assets. Let's do the same process on the other side of the equation. Well, there are no liabilities. We're going to add the $75,000 in capital, subtract the $3,500 in withdrawals, add the $24,000 in revenue, and then subtract the two expense amounts of $750 and $190, $94,560. So assets equal liabilities plus equity. If that isn't true, you've got to find out why, and you've got to fix it before you go to our next step. So this is how we introduce you to summarizing transactions so that we get them in a summary level. We take all that detail and get them into summary level, that final balance, so that we can then create our financial statements. So here's our first financial statement that we usually do. It's an income statement. Income statements are where we report the revenues and expenses only for a company for a period of time. We always start a financial statement off with the heading, the name of the company, the name of the financial statement, and the date line. Since the revenues and expenses for this company or any company are collected over a period of time, in this case, the month of April, we put the month ended April 30th. If you just wrote the date April 30th, it would look like all the revenues and expenses occurred that day. They didn't. They happened over the month. So we're only focused on revenue and expense columns. Don't start adding other stuff in there. We already have everything defined. Assets are assets, liabilities are liabilities, and the parts of equity are the parts of equity. Now we're just transferring the information onto reports. So we start with revenue. And if you refer back to your spreadsheet, service revenues, final balance in that column is $24,000. So we list that. And then we list the two expenses of Allen Shotton. The final balance of rent expense, $750, utilities expense, $190. We add those two together, $940. Notice we don't show those amounts in brackets or put minus signs. Nope. Okay, but we do know, and we have to keep in mind, that we will be subtracting total expenses from total revenue, and that is the result. If it's positive, which in this case it is, $23,060 is our profit, or in accounting we call it net income. Okay, so if that was a negative, we would put net loss. Okay, so this is reporting to decision makers the profit for the month of this company. The next financial statement we complete is the statement of owner's equity, and that's where we report the change in equity. So all those parts of equity over a period of time. So we start with Allen Shotton CPA, statement of owner's equity, month ended April 30th. Now, since we're showing how equity changed for a period of time, we need to know where it started. And whenever a company starts, just like when you open up a new savings account or checking account, you always start with a zero balance. So Shotton's capital as of the beginning of the month was zero. The first thing we do is report items that increase equity. Well, the owner contribution definitely did. So we take the information from that column, $75,000. Revenues and expenses are part of equity, but we've already reported the details of those items on the income statement and came up with a final number or result from those two items. And that was net income. And since net income increases capital or owner's equity, we will add it. So net income for the month, $23,060. At this point, we usually do a mathematical operation of adding up all those numbers. So $98,060. The only other part of equity that has not been accounted for yet are withdrawals. We will then subtract the withdrawals amount. So with this, and finally, Shotton's capital balance at the end of the month would be $94,560. So this is showing decision makers, especially the owner, you contributed $75,000. The company took that money and made you a profit of $23,060. That's really the owner's. And it's up to the owner if they leave it in the business to be used for other purposes or takes it out. And Alan Shonten decided to only take out $3,500 of what is owed to him in equity. So right now, the company owes Alan Shonten individual $94,560. The final financial statement is the balance sheet. And this is where we report the balance of assets, liabilities, and equity on a specific date. So we start with Alan Shonten CPA, balance sheet. This is as of a specific date. Here's the balance in these areas on April 30th, 2018. Here are the assets the company owes, the liabilities and equity the company owes. So we refer back to our spreadsheet. We'll start with assets. There were 3 assets with balances. You do not have to put an asset if it does not have a balance. So cash, $84,760, office supplies, $300, and furniture, $9,500. We'll add those all up. The total asset balance or amount, $94,560. Now, I didn't tell you about this, I forgot, on the income statement or the statement of owner's equity, but when you come to the final amount on those financial statements, we usually double underline it. And we do the same with total assets, and you'll see that in your book. Okay, so just keep that in mind. You're not doing stuff on paper in this online class, but just so you're aware of that. So if you go to a traditional class or are an accounting major, you remember that. Now we go over on the other side of the balance sheet and we start with our liabilities. Notice we list the liabilities, but since accounts payable has a 0 balance, your author doesn't put it on here. But keep in mind, normally our liabilities are not 0. We're very lucky if they are, but if a company has any liabilities, you will list them there with their dollar amount. And then the final area of the balance sheet would be owner's equity. Now, you don't have to rewrite everything from your spreadsheet with regards to owner's equity. You don't have to write all those 4 items. We already did it on the statement of owner's equity. I can't go backwards on my presentation, but if you refer back to your statement of owner's equity, we determined on there the final balance of equity, capital, on December 31st, or I'm sorry, on April 30th, 2018. So all we do is transfer that final amount over to the balance sheet. So Sean's capital is $94,560. We then add the liabilities and owner's equity together and double underline that. Assets must equal liabilities and owner's equity. Okay, so those are the major components of this chapter. There's theory there you have to read through, of course, the history and some background on accounting. But as far as what do you need to bring forward problem-wise, it's this. So it's imperative that you get this process. So please post any questions you may have to the discussion board. Email me, whatever kind of clarifications you need so that you can move forward on this. Because Chapter 2 is now going to take, when we get there, is going to take the information from Chapter 1 and add some more steps to it. So again, review this, practice it, and ask any questions you may have.